Hi, this is Kelly Wright at the Money Show in Philadelphia. With me is Bryan Perry of the Cash Machine. Bryan's forgotten more about income than most people have ever known. Yields are all over the place, but some folks are finding trouble getting good yields, so they're looking at the option market.
Right.
Why don't you talk to me about what's working in option market? What are you looking for?
Well, certainly people want to be in the good stocks because they want to be part of this longer bull trend that's in place.
Right.
At the same time, if they're income investors or they're retired, they really need yield at the same time.
Right.
So what I would call a semi-actively managed covered call strategy makes a lot of sense, especially in a volatile market like we've got right now, because option premiums expand when the market is, it goes into a wide trading range, as we've seen. So even on stocks that are like consumer staples names, that the Pepsis of the world or the Procter & Gamble's, that kind of thing, which is like, you're good. Church and Dwight, it was a recent one that just I've added recently, and names like that are, you're not going to get really hurt on bad days, and at the same time, there's enough juice in the market that you can write some near-term out-of-the-money calls, out of the money, and it's a two-step process I take, Kelly. I buy the stock, I look for a 1 or 2 point move, and then I sell the call. I don't sell them right at the money, because then you really risk being called away very quickly on your position.
So let's help everybody out here real quick. Not everybody's going to know how covered calls work.
Right.
So walk us through, what does it mean when you sell in the premium and this and that?
Well, options are like, it's like a contract to rent a stock, or from the standpoint of I have the right to buy it at a certain price.
Okay.
You have a strike price, and in this case, let's use Pepsi. It's $120 or $135 stock.
Okay.
And let's say we want to $125. So let's say we want to buy the right to own Pepsi or at $130, or we want to have the right to sell Pepsi at $130.
Okay.
So it works either way. Calls are the right to buy, and puts are the right to sell.
Okay.
So let's say we buy Pepsi, and we think that the stock's going to move to $130. Okay. So we buy the stock. We see if it moves up about $126, $127, and then we'll look at the December contract. And all options have a monthly contract expiration every third Friday.
So they expire. They don't live forever.
Right. No. It's like a land option. When you buy, an option on a piece of land.
Okay.
For a certain amount of time or at a certain price, and then it eventually expires if you don't exercise the right. Stock options work the same way. In this case, we want to have the right to sell our Pepsi at the end of December for $130, and if the stock doesn't get up to $130, then our option's worthless because the stock's trading under our strike price.
Okay.
It's what good is it?
What if the stock goes to $132, $133?
Conversely, if it goes to $130, and we paid 50 cents for that option, now it's worth $2 to $3.
Wow.
You've just made 4 or 5 times your money, and you're going to get called away because you own the underlying stock, which is called the underlying asset. And if the stock moves up from 125 to 130, you made 5 points on the stock.
Right.
You sold the right to sell it to somebody else, at 130. You collected, another 50 cents or so, and what you've done is you've collected, some income. Mm-hmm. And if you can do that 3 or 4 times a year and capture another $2 in premium, and sell your Pepsi, and whether you get called away or whether you just collect the premium. Now, bear in mind, if the stock closes below 130, say you've sold the call, and the stock closes below 130. And you still own the stock. You still keep the premium.
You put the money in your pocket for selling it.
Selling it, and then you still own the stock, and then you just go out to March and do the same thing again, sell the 135s.
Okay,
so keep walking it up.
So there's a price component and there's a time component.
Correct.
Okay.
Correct. Price and time is everything about options.
So what do you like then? I mean, what's working for you right now in the option market?
Well, I think right now because tech has really come in a lot recently, mainly because a lot of multiple compression in the cloud stocks and a lot of the high-end names. There's been a lot of good rotation in semiconductors. Okay. There's been a lot of good rotation in what I would call the big heavyweight blue chip names like Microsoft, Salesforce.com, IBM, Texas Instruments. There's as the market goes higher, it gets more narrow. It's kind of like a marathon. Everybody starts out, in the bottom of a bull market, like back in March of 2009.
Right.
Everything was cheap. And now it's like the pack starts breaking away as the market gets more extended as we get, more mature. So it tends to gravitate toward the bluer chip names that are trading with a multiple that you can understand.
Right.
Versus metrics, as they all say. So tech looks cheaper here because the fourth quarter and the first quarter are typically the strongest for tech.
Right.
And all that stuff has come in, all the big names have come in because of the real crunching that a lot of the high beta stuff has been going through. So there's a little baby that's getting thrown out of the bathwater during this particular cycle right now, but we're coming into third quarter earnings season, and the fourth quarter is going to take shape. And you have a Fed meeting coming up here, which is probably going to be proactive.
In December.
Yeah, and you've got more dividend buybacks, you've got or more stock buybacks. You've just had Microsoft, Texas Instruments, and the big names raise their dividends again.
Right.
So the whole rebalancing, the year-end rebalancing is taking place. It's a good time to look at. I've just added Microsoft and Texas Instruments and Salesforce to the covered calls.
Okay, so those are companies that everyone's heard of, everyone knows, and
trust in the names.
There you go.
You know, and they don't pay big dividends, but you can sell a lot of covered calls against them and generate a nice fat income off of those names.
And if income's what you're looking for.
Yeah.
Folks, you heard it here. Mr. Bryan Perry, the Cash Machine. I'm Kelly Wright at The Money Show, and thanks for joining us.